This is Chad, joined with a Thursday, October 9 Market Minute from Trader PhD Ag Marketing. In the grains, we're due for an adjustment in our overhead price targets. We really don't need to adjust them today, so be looking for something next week. There's no October WASDE release today due to the government shutdown. That didn't stop folks from making estimates. Trade guesses for yields has corn substantially lower, down 1.7 bushel per acre to 185, and the soybean yield trade guess is down slightly, down 0.3 bushel per acre to 53.2. There's something interesting going on in soybeans. COFCO has been bumping up their bids in soybeans quite substantially. Jumps in their bases have been over a dime higher at river terminals. Why is COFCO bidding so hard on beans? COFCO stands for China Cereals, Oils, and Foodstuffs Corporation. They are a Chinese state-owned enterprise for grain imports and exports. And since the government shutdown, there's no reporting going on, and they seem to be aggressively buying soybeans. The APEC summit where Trump and President Xi are to talk about soybeans is at the end of this month. Is China buying U.S. soybeans under the radar ahead of the meeting? Is this a goodwill gesture? Or will purchases be threatened to be canceled as leverage? Anyway, it's nice to see something resembling Chinese buying of soybeans. We'll see what happens. In the wheat complex, we still remain in this long squeeze, resulting in a slow bleed of prices. What's a long squeeze? It's where the weak longs in the market get squeezed out by lower prices. Some speculators see the cheap price of wheat and they try to pick a bottom, and then they buy and go long with their broker. These longs are weak if they don't have the staying power. They will jump out when they have a 5 or 10 cent loss. They are weak longs. And when prices just keep trickling down, these weak longs are squeezed out of the market and they have to sell to exit their position, and their selling just helps perpetuate the downside move. And this market phenomenon can last for months. Corn and beans have periods like this as well, so it's not just a wheat thing. On the charts, corn is on day 5 of a ledge, a tight sideways trading range. You know the drill on these ledges. They like to bust out of there. It may seem like the market is at a comfortable trading at this level, but you often have moves like this where the market breaks out of the ledge and doesn't revisit that price level. Corn is fighting some weakness in ethanol after we had a drop in the crude oil market. Crude fell after it was announced that there's an agreement for hostages to be released in Gaza, easing Middle East tensions. I think we could continue to see some weakness in crude. In soybeans, you see a subtle uptrend for the past week, a positive tone, and this may continue. I'm still calling these grains to be mostly sideways for the next couple of weeks, and wheat is likely to be sideways to slightly lower for the time being. In cotton, yesterday we dipped down and tested the April low, and it was a failed test as expected. That doesn't mean that we are all clear of danger. We need this market to firm up, and if it doesn't, we could see cotton continue to slide. I'm not seeing any signs of this market firming up, so I'm calling cotton lower. In fats and feeders, last week we put in an alert to price some cattle, with the warning that a screwworm outbreak could rocket these markets higher faster than we could ever exit any shorts. Yesterday it was clear that we were going to close at a new contract high, the signal to exit any shorts. And what about the out-of-the-money call protection? Look at what we have. In feeders, the November 370 call with a strike price that represents a new contract high. It was trading at $325 last week, October 2nd, and today it's worth $1065. It's more than tripled in price. So now you're sitting with a loss on your short trade, and now you've got in-the-money calls that's probably worth sitting on unless you just like being a pure hedger. An above-average complex trade allows you to take stabs at the market without taking too much risk. This is the notion of courage calls. When you sell grain, you can do it in tandem with buying calls to give you the courage to make the sale without the fear of missing the upside. For live cattle, December hasn't broken out to the upside yet, but February and further out has. I think that we're going to see more upside in the cattle complex for the time being. What will finally put in a market top? Either way, I think that we will have elevated cattle prices for quite some time to come. And in hogs, we got the short-term slip that we were in danger of. I still think we can see volatility come down and prices rebound. Dips like this have been discounted in the recent past, even the real doozies. The most likely thing to happen is for hogs to carve out a trading range low if it hasn't already. One more day lower, and I think this down move should be exhausted. That's it for today. I'm Chad Toyne, and this has been Trader PhD. Past performance is not indicative of future results. Futures trading involves substantial risk and is not suitable for all investors.